I can't tell what's more confused right now, the social medias or the actual market. On social media, we see some people saying this is the best time to short ever, and other people are saying this is definitely going to go higher. The S&P is going to double by the end of next year. This is crazy low prices to buy. And in general, it seems like most people are in the middle, just confused on what's going on in the market. Let's try to provide some clarity. Now, before we actually talk about what's going on with the index, let's also just shed some light on some general principles. This is the corniest thing I've ever done. The point is that you don't have to be always one-sided in your portfolio. And I see a lot of people that are getting burned on Twitter right now are either one-sided short or they're one-sided long, and this market's just going sideways and they're getting burned. But over the past week, a lot of the success that I've had, and actually for the entire year when I look at my trading log, has been on individual names. If you've been watching my videos coming in the last year, I said that this would likely be, stock picking season, especially as a lot of these macro trends start to evaporate. And so now we're just playing with who's going to be cutting the most jobs, bringing their margins down, and proving that they don't just have to spend exponential amounts of money to make sure that they actually make exponential profits. And we're seeing this happen with a lot of companies, right? A lot of companies are big losers. Let's say Roku, for instance, where the instant they stop spending absolutely exorbitant amounts of money, their profits dropped with it. And right now, the market wants you to prove that you don't have to spend a ton of money to actually become a profitable company. Because remember, a lot of the promises made over the past few years when money was cheap, pretty much free, just take out more loans, take out more credit, and just continue to drive growth. The idea was the trade-off would be that your profits would eventually catch up, and then you could pull back on the amount you were spending, but profits would continue to climb. Or at least some sort of chart where you're seeing that the expenditure is going up, but then levels out, but profits continue to rise. But that's not what's happening for a lot of these companies, which are proving to be not very sustainable business models, and the market is punishing them heavily. And when it comes to an environment like this, you can pick winners and you can pick losers. You can play the market on both sides at all times. So if there is a big macro move on the market that's going against where you're weighted in your portfolio, let's say you're more weighted to the upside or the downside, the market moves heavy against you, you start to lose, at least you'll have picked out some shorts and some longs that will catch you if the market moves aggressively in either direction. And I think that's very essential right now. And I see a lot of people making this mistake. You do not have to get one-sided in your portfolio. In fact, I never try to be one-sided in my portfolio. Even if I'm one-sided bullish, I still try to keep some hedges open as well. So today we're going to start with talking about a stock that I like to be long on, a winner, and a stock that I like to be short on right now in this market. So let's start with what's been a big winner for us that I think is now a loser, and that's Netflix. We played this 5-wave pattern all the way up, made some great profits here, but I sold my shares and I set up some option puts now that it seems like the 5th wave is completed. Now, it's important to note here that this actually went over my target, which happens with Elliott waves. Remember, this isn't an exact science, it's more of an art. But since we're now here, we're now overbought. It seems like the TTM squeeze is also topped out. We see that a double top is pretty much formed here as well with the top of the 3rd wave. The 5th wave does not usually extend larger than the 3rd wave, which allows me to say, hey, this looks like the top for this stock. I would expect an ABC retracement to the downside. And on top of that, I think the overall market's pretty weak. So if I give this some time, it might even just move with the macro market as well. But then I can also play the individual trade on this stock. And that's why I like it as a loser right now. And now for our winner, and that's Shopify. And shout out to New Trader. He's now one of the moderators in the Discord, or as we call them, refs. You've probably seen him type in there a lot. He's a very experienced trader, trading for over a decade, but he's mostly on the sell side of options, not as much buying options like I do. We have very different trading styles, which is why I think he's a great moderator in the Discord, because he offers a completely different perspective than I usually have on the market. And I love that diversification for our community. But now when it comes to actual Shopify's technicals, we can see that we have this very large inverted head and shoulders on the daily chart. We can also see that Elliott waves are playing out right here. The 1st wave, 2nd wave, and now the third wave up. This looks like a very strong Elliott wave pattern right here. The third wave is usually the best to play to the upside. Now, the one thing here, and the reason why I did sell some options today, is that we could see that this stock is getting pretty overbought. It's 72 RSI on the daily chart. It's also overbought even on the 1 minute, where we saw that, you know, it was also creeping up to 76 RSI. So in the short term, I'm going to look for a little bit of a pullback, and then I think this is a great time to reset those longs and go and play this further upside on the stock. I mean, if we look at where it's at right now, we're at 47 right now on the price. You could probably get back in around 44 range, and at which point you still have about 45% upside on this stock, and that's just on the straight shares. So I think on the options, we have so much room here. I like this right now. And remember, when you're playing this, you're playing it also with some losers, so you can win on both sides in the market through all this ridiculous chop that seems to be really killing a lot of people's accounts right now. Now, let's also talk about the S&P and just see what we see on the technicals here. We're going to go over some fundamentals in a moment, but what we're seeing here is that this upper trend line is continuing to hold. Still no major breakouts. We were following this lower trend line as well, but now we're starting to see higher lows start to play on the market. And we're getting this wedge development on the daily. I think this is important because I think this is going to signify a big move to the upside or downside very soon. And I'm favored more on the downside, but an upside that pushes us to maybe 420 would not be the most shocking thing in my opinion. At which point, though, I would be just jumping up and down to get short. Like, I would be so excited to get short at that level. It would be such a strong short position on this market. I don't know, but given that, I don't know if we're actually going to see it play out. I'm not favored to the upside right now. And I think it's also important that if we do see a downtrend, we're probably going to want to start following this tighter trend line right here with these two bottoms here. And I would expect it to come visit this line as well. So I know this now looks like a mess because of all the different lines here. It looks like we're trying to create a spider web, but this is what I think could potentially play out, where you see that we get a break to the downside on this wedge, and then we come and touch this trend line right there. If we look at oil, not much has changed here. I pretty much have the same opinions that we had on last week's report. If you missed that one, make sure you go check it out where we talked about energy. Still same opinion here. The only thing I want to add is I know traders who were short on oil who disagreed with what I was saying, and a lot of them got blown out of their positions. They do not like how bullish this is looking, and I am just happy as ever. Now, when it comes to natural gas, still the same opinion here. Now, this has bled more than I would like, but I had a much smaller start in this position than I did in something like oil. So I'm fine continuing to build up that position as this continues to come down more. It's clearly oversold right now at a 29 RSI. If we look over here, you can see that. And I mean, go watch last week's video if you want more insight there. Now, when it comes to bonds, bond traders look confused. It looks like they're trying to time a pivot, trying to figure out which side of this they want to be, if they do need to give it more time. We've seen a lot of choppiness here, and it's been really interesting to see on these really bullish days for the S&P, bonds have not agreed with this rally at all. So if we see the S&P going up, we should see bonds confirming that move. And I think that's what's leading to a lot of the weakness and why we can't actually get a breakout here. It's going to be really important to pay attention to the bonds if you want to see confirmation for the bullish moves in the S&P, because this will be indicative of, yes, the Fed will pivot soon. However, since the recession conversation has become a lot more mild than it was at coming to the end of last year, where people were saying we're going to get this very sharp, severe recession that might blow over quickly. Instead, everyone's saying now that it's going to be a more mild recession. Of course, all of that is going to be backward looking, which is why the Fed tends to be so terrible at timing a soft landing, because they tend to over tighten since they're relying on backward looking economic data. And I think that still I want to be bullish here, because the Fed always crashes the market. They always over tighten. They've never gotten good at this. And in fact, over the past 3 years, I think you could say they've only gotten worse. Now let's talk about what's going on for the economic data points. Now, tomorrow, some people seem to think that this GDP will have a huge impact on the market. Honestly, this is backward looking. And on top of that, I think no matter what happens with the print, no matter what data point you get, the bulls and the bears will be able to convince themselves that it's in their favor. So I'm not expecting this to actually be a big market mover. Instead, what I'm mostly going to be focused on is next Wednesday. Remember, the February 1st. We just talked about this earlier on the report. I think that the Fed interest rate decision will be huge. We're going to get 25, or we're going to get 50, or we're going to get a pause. I think a pause is unlikely. Considering how this market has been forming so far. I think probably if you ran a poll on Twitter, we'd see most people say 25, but I don't think a 50 base point increase is off the table. And I think the PMI is also going to be a big deal. This ISM PMI is going to tell us, hey, is manufacturing still slowing down? Are we still seeing some hints that maybe this recession is not going to be mild and going to be more aggressive? And then later that day, are we going to see the Fed then do 50 basis point hike? That could murder this market. So I think it's going to be really important to stay focused on what's going to happen next Wednesday and make sure you're not one-sided bullish when you come into this report, because you could get slaughtered. If you made it all the way to the end, I love your face. We're almost at 300 subscribers, so I would love it if you subscribe to the channel and like the video. It helps so much. I'll see you in the Discord.